Welcome back to the weekly watch list. We're going to kick off an informal analysis here from Barcelona. Bienvenidos a todos, although I don't even think they speak that Spanish here. It's Catalan from what I understand. Anyways, welcome to the show. We've got the SPY monthly bars that had closed out. Of course, for the month of November, solid green-bodied bar, closing extremely strong near the top end of the monthly range. On the bar-to-bar count, you can clearly see a higher low as well as a higher high. It is, of course, bullish. I think right now what I want to just remind folks of is that the monthly chart will clearly tell us when there is going to be a big painful moment in the market. You'll get a double top like this, you'll get a lower high, you'll get lows, you'll get lower lows. When we're in a monthly downtrend, bad things tend to happen in the market, and we can see a very similar pattern here in the Great Financial Crisis. Double top, lower high, lows, lower lows. We're in a monthly downtrend, really bad things happen in the market. So you're going to start hearing a number of folks out there into the end of the year saying, this has to be the top, the market's got to pull back, it's got to do this, and the other thing. It doesn't have to do anything. It can continue in the upward direction, and generally speaking, you need a monthly downtrend to emerge. Notice the lower highs and lower lows here before really bad things happen in the market. So if good things are going to continue, what's the measured move that we still have to consider here? Of course, it's from the sickness low to the top end of the rally to the pullback low of 2022. We know that we're still not quite all the way there yet for the measured move target, which is sitting around 610, right? So using 610 on the monthly time frame chart still makes sense here. Still bullish on the higher time frame monthlies. If we drop it down to the weekly time frame chart, notice that we opened on a gap up last week, and we actually closed that gap to the downside, filling it with that lower wick, and then closed at the top end of the weekly range. So weekly structure is technically a bullish hammer here, which in nature is just bullish, and we've closed at the tippity top, new all-time high close on the weekly. So all set from that perspective. If you're thinking about the bar-to-bar count, obviously a higher low and a completely strong close outside of and above all of the other clusters of highs. So the weekly and the monthly both remain bullish here, and it does mean that the weekly chart can technically afford another higher low. I would really want to see sustained price activity probably over the gap close location. That way this sort of turns into somewhat of a daily bull flag, and we'll see that in just a minute, that continues to break out in the upward direction. Anything that starts to flirt with the lows of the flag on the weekly, that starts to become a little bit more concerning here. Let's drop it on down to the daily time frame chart. We'll get really granular here as we come into the daily and then hourly. So what you can see is, again, here's that Monday morning gap up. Gap fill reversal on Monday's session tells us what? Well, it tells us that we don't really have stronger sellers present in this market. If we did, sellers should have fought for price acceptance back down inside of last Friday's range, and even price acceptance underneath this level from in the past. Clearly that did not happen. We then got consolidation for two back-to-back bars up here. Of course, Thursday the market was closed for Thanksgiving, and on the short holiday session for Friday, the market broke out to brand new all-time highs. Very constructive look here, which once again is not indicative of stronger sellers getting active in this market. If I show you the full weekly expected move, it is right here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. The upper bound is at 609.44. If we're contained by that, that of course would be a brand new all-time high and a higher high in the trend count. Notice it's also just shy of that monthly bull flag measured move at 610 that we were just talking about. If we're contained by the lower bound here at 595.67, that of course would offer some semblance of a higher low pulling back from the highest high. As we mentioned on the weekly, we really don't want to be underneath 595.25 is the key level, and that would sort of suggest that the weekly bull flag consolidation can persist and possible continuation over time. The place that starts to get really dangerous for the bulls would be if the market breaks down below that level. This is 595.25 right here, finds a lower high and then continues to the downside. Of course, from there, it wouldn't be too much of a stretch of the imagination to imagine that the election gap ultimately closes underneath 583.85 down here towards 576.75. Is that likely for this week? Probably not, just considering how far it is extended through the lower bound of the weekly expected move. There are some more nuanced levels in here, so let's take a look on the hourly time frame chart and see what else we can learn about the price action here. It's been a pretty slow and steady grind in the upward direction with plenty of give and take. The gap up sort of faded, as we mentioned. Where did we find support? Beautifully off of the level and staying outside of that previous Friday's range. From there, we go on to set higher lows on the hourly trend count, which is bullish. We set up some sort of pie in the sky double bottom. You could say low, higher low double bottom, call it a W pattern, whatever you want to call it. Here's your Friday breakout, and look at the consolidation strong into the afternoon session there, right? So 603.35 is your current all-time high. We repaired the overnight extended hours all-time high that was set from back here. We no longer have to contend with that. The chart structure here is fairly straightforward, right? The pathing that we're going to look for is any consolidation here, builds Brigade bolts into the blue sky territories, targeting 610, the measured move. If we get this consolidation that breaks down, not the end of the world. I would give it a second chance opportunity here, trying longs off of 595.25, poking back up towards the all-time high, and ideally a Brigade bolt into the future. I would have to put my neutrality hat on if we start to see something like, let's say we come down here, fail a lower high there, and poke underneath. So this level, the higher low from the W pattern, is at 597.65. It's not the strongest level in the world. I'm not saying you should second mortgage the house on that. But if you do see a lower high there that then subsequently breaches underneath 595.25, or if this just comes straight down underneath and sets a lower high here, that's where I would start to put my neutral to bearish hat on the intraday and say it's definitely possible that you get an hourly trend change to the downside through some sort of structure that looks like that. From there, the target has to be this larger breakout area, which is 590.25. I would really start to consider that the daily higher low line in the sand. Like, there's no ifs, ands, or buts about it. You have to hold that as a daily higher low. So you could at least say this was your previous daily higher low, and what you're looking for is a constructive move to set another one. That would be that line in the sand. Once again, the number is 590.25 here on your Spiders cash. Obviously, any consolidation to the downside with a lower high here, as discussed on the daily, is inherently bearish. So as of right now, the trends and basically all of the tailwinds I can see in the market here do continue to support further upside. And again, you can just sort of confirm these things if you take a look at the market internals. Nothing was really bearish last week. The most bearish day was on Tuesday, where we know that the market technically put in consolidation back to the upside. So is there anything wrong with that? Not seeing it. If we're thinking about the advanced decline line, trend higher zone on Monday, near trend higher zone on Wednesday and Friday, as we're getting that follow through to the upside, specifically on Friday. How about we look at Friday? Was it being supported by inflows? Yes, as we're breaking to new highs. Were we near trend higher zone? Yes. The index score was pretty strong up here towards 13. The cumulative build, of course, this is just going to be skewed because of the way the market closed there, but it was well on its way by about noontime, over 2,500. So I could have imagined if we had a full session on Friday that this would have built out to substantially strong reads around 5,000. If we're thinking about the earlier stages of the week, the other day that would make sense to read into would simply be Monday due to the magnitude of the gap up, right? Well, Monday's volume flows were into the market, advanced decline line was higher, and the cumulative build, although it closed fairly flat towards zero, it was not negative as the market sold off all day to basically close that gap. So generally speaking, the sentiment still stands. We are not seeing any indications of stronger sellers getting active in this market. Here's the market profile. This is a funky version because I don't want to adjust my time frames for the proper charts I have when we make it back to the penthouse location number 2. Maybe considering penthouse location number 3 instead of down in like Florida or Texas. Perhaps it's over here in Barcelona. We shall see. But what do we have out of the market profile? Any major concerns? Not really. Here's value and point of control higher on Friday. Here is the shortened Thursday session. Futures were technically open there. Then we have, this would have been Wednesday, Tuesday happening here, and then we have the Monday session. So all things considered, value certainly progressing in the upward direction, solidifying that the breakout does have some strength or acceptance behind it as we're pushing to new highs. Poor high here on Friday is worth calling out, possibly some repair there, then a pullback that stays over the multi-day highs sort of looks interesting for continuation in the upward direction. And if we just go back on over to the platform, of course, what that would mean is if you break this high, pull back and support over $600.50, that's the exact situation I just described on the market profile. Let's continue along here to the good old nasty NASDAQ, and we're going to jump this up to a monthly time frame chart, and we'll see what's going on from the top-down perspective here on the other of the major indices. So we have NASDAQ printing a solid green body bar, a little bit more of an upper wick than the S&P 500, but nothing to be concerned about. Certainly closed over the top end of both of the upper wicks from back here, closing at a brand new monthly all-time high. That's bullish. Bar-to-bar count produces a higher low and higher high. Really nothing bearish to say on the NASDAQ monthlies. And even if you go out to a max time frame chart here, something like this, we can see the same exact indications. Here's the .com bubble, right? Lower high on the monthly. Here's a big neckline, painful moment, lower high, painful moments, continue into the early 2000s, right? And if we take a look, we don't want auto arrange. We want to take a look at 2008. Here it is. There is your monthly lower high, another one, and then things get really bad, right? So the main premise is, do not overcomplicate your positioning, even like from an investment time horizon. Does it suck to not nail the top? Yes, but big moves to the downside to sidestep sort of downdrafts in the market that are substantial in magnitude, like these two instances that we historically reference, it really doesn't make sense to try to, get out before there's a monthly downtrend, right? You can see here that although the monthly pulls back, there's still a huge amount of gain left in 2021 before the market sort of gives it all back in 2022. And even if you just sold on the lower high happening here through the equal low, you would have net an additional, gain here rather than panic selling on the lows and then missing the entire move that happened to the upside. So not specific investment advice for any particular individual, just talking about trends, talking about charts here. There's no reason to overcomplicate things. On the monthlies, bad things will not happen unless the monthly falls into a downtrend, right? Obviously, we know what this is. It's the sickness. You can't really prepare for a black swan event. But generally, if the bubble's going to pop, it's going to take some time. Things will unwind, and you will have a monthly downtrend. So we just don't have that yet. Bullish on the monthly time frame. Can we all agree? Strong close up here. Nothing to really be overly concerned with, right? Let's drop this down to a weekly time frame chart. Very similar to the S&P 500, gap fill reversal. You ended up closing back over the previous week's range. You did not get a new all-time high here, though, which is not concerning per se for the NASDAQ, but it is something to at least make note of. The short-term trend remains up with lows, higher lows, higher lows, and of course, this could potentially hold as higher lows. When we had talked about this pullback originally, we liked the fact that this came into this support, previous resistance, acted as support, and started to push in the upward direction. Still looks like that's the case with the hammer that printed on the previous week's worth of trade. Let's drop this down to a daily time frame chart, back over to the NASDAQ here. Take a look at the weekly expected move, the trend that's going on, and what we can see from a measured move perspective, because the weekly bull flag target is right here as well on the NASDAQ. It's 518. The upper bound of the measured move is technically at 517.64. And that, of course, implies not just a higher high in the trend count, but a new all-time high as well. So that is, what would you say, a little bit more confidence inspiring out of the tech side of things, as long as a couple of things can remain true. The lower bound of the weekly expected move is at 501.63. As long as we're above that, I would really argue that the market's trying to hold up for some kind of higher low. Generally speaking, the market was much more balanced out of the NASDAQ over the last little bit. It did not extend the rally on the Friday session. So as of right now, I think the chart's very straightforward. Any consolidation here on the daily is exactly that. It's consolidation, and it's actually range compression. You could draw in a resistance trend line and a support trend line that looks something like this, compression, and then hopefully, one of these take place. Because of the weekly, because of the monthly trend, I would tend to think, also with the S&P leaning a little bit more bullish as well, I would tend to think this is the outcome I would prefer to trade for. Higher lows over 510, target the all-time high and go through the all-time high for a move up to the weekly bull flag measured move, which once again is at 518. Those are the upside targets. Of course, any consolidation that just goes sideways, you're going to have to trade ranges, right? You can fade the highs, fade the lows, and that'll be that. Mean reversion is the name of the game. Mean reversion is the name of the game. That's not really the type of trade that I personally do well in. So if that's your mojo, then all the best to you between 510 and the key level to the downside being, of course, 503.25, the top end of this balance range down here and very close to the lower edge of the weekly expected move. As long as we're above it, I'd say it's still bullish consolidation. If we start to slip underneath, now it starts to feel a little bit more dangerous for, of course, what's the pattern? High, lower high, you get back down here and you break for a lower low. Now all of a sudden you're back into a daily downtrend, like we were sort of, it wasn't the cleanest one, but we were trying to navigate the beginning stages of a daily downtrend. If I just zoom in over here, right, we had technically breached and made a lower low from there to there, and we could possibly have a stronger daily downtrend opportunity if we come into this. And now even using some more data, you have big left shoulder, head, right shoulder. All of a sudden, a neckline looks a little bit precarious here. And I'm not going to say this is the magic trend line to end all trend lines, but underneath that level, yeah, I could certainly see the argument for that technical formation. I would really, I would personally reserve the right to be bearish until we're actually underneath this zone right here, making a new lower low, not just trading into an equal low. That's 497.50 on the QQQ daily. So yeah, there's some more concerns out of the NASDAQ side of the market, but currently I do like the sort of expression of lows, higher lows with the hammer on Thursday. We closed the gap. The market didn't really go any lower than that. You can see here on the hourly chart even, as we take a closer peek. This would have been what, the Wednesday session? Or the Tuesday session? Wednesday session. We looked underneath this 503.25. The sellers absolutely failed to get continuation on Friday, although a shortened holiday session clear rally responding off of that level straight back into the equal highs. So I think it's a pretty straightforward chart as mentioned on the daily, but even here on the hourly, you can see you have a nuanced level at 506.25. If you can hold up over that and Brigade bolt out of 510, good to go. We want to give a little bit of respect here to 512, but really 514.85 is that target. If we were to breach underneath 506.25 and really put in like hourly bear flag, 15-minute bear flag, I could see the argument for maybe a trade that looks like this. But once again, I would probably reserve the right to be bearish underneath 503.25, trading for an equal low on the daily. So this is hourly downtrend changes, right? And then the daily downtrend changes once you're here underneath that 497.50 that we were just describing. Currently, still a little bit more bullish than we are bearish here on the QQQ NASDAQ. Let's take a look at the market internals for the NASDAQ side of things. And by the way, if you're not familiar with the NASDAQ or the S&P internals, check out the video tutorial in the top right-hand corner. Just like the S&P will really focus on the Friday session, since that's when the rally happens straight back to the top end of the range, you are getting bullish volume inflows. Your near trend higher zone here and the cumulative build actually closes out decently strong. I mean, again, take this read into the close of the session here. That is around 2,200, give or take. A better read down here in the NASDAQ tick would be 6,000. So not quite halfway to the substantial read like the S&P 500 was, but I think the reiterating force is just that we did not have aggressive bears. Even here on the Wednesday session, when the market was breaking down aggressively to undercut that low we just described, I mean, the cumulative tick got down to about negative 3,800. You did not have strong volume outflows, and we were not in trend lower zone on the NASDAQ advanced decline line. So really not seeing a bearish argument there. I mean, was there some selling? Yes, but was it aggressive selling? I wouldn't really classify it as that. Let's jump on over to the NQ on the updated TPO profiles here and see what's going on from this perspective. We can see that generally, I think there's a small danger because of the way value closed on Friday. It is technically higher in this price action grouping, if you will. The reason I say that's dangerous is because it's easier for those traders to turn into overhead supply if we start to break underneath the value area early on the Monday session. That might be something like around 20,950 in the NQ futures. If you break below that, basically if you take out Thursday's high, sorry, that would have been Wednesday's high, underneath Wednesday's high starts to get a little bit more rotational looking back down towards sort of this area over here, right? If you sort of take out this level, that would be the equivalent of 508.25 in the QQQ. If you take that out, I would sort of think about the rotation back to the downside, noting that, again, you have overhead supply as considered by the market profile. If you get consolidation up here or even just a Brigade bolt to begin, then all of those traders from the shortened Friday session, which probably isn't a huge number of traders, but they are happy. And thinking about the psychology of traders, right? They're feeling good. No reason to close out over 510. Markets should rotate in the upward direction. That is the take out of the QQQ. Let's take this on over to the good old IWM and see what's going on with the Rusty Russell. And we'll jump it up to a monthly chart as well, just like everything else. Throw on the clean drawing set. And it's just a pleasure to, of course, announce that we did make a new all-time high. We did not close at that all-time high, but we did make a new all-time high here out of small caps, which is powerful because now clearly on the monthly time frame chart, what would it suggest? If this pulls back, there's plenty of opportunity on the monthly for a sustained higher low over the top end of this range, which, as we know, is closer to that 227 we were describing on the weekly. Generally speaking, if this does pull back, give it a chance to build out a cup and handle, and then new highs can persist. Remember, this is supposedly going to be the year of small caps as M&A activity potentially picks up. You're seeing new drug discovery in smaller biotechs with AI, although, of course, we had some panic and regulatory issues around the RFK appointment, so I'm not dismissing that in total, but generally, it's the sentiment of the market is, and you can just see this in price action, is that this is all positive developments. These are bullish developments for the small cap environment. So the monthly chart agrees with that. We don't have any big measured moves here, not that I'm aware of, that we should be paying attention to just yet, so all set from that perspective. If we do just jump out to a max available chart, and we could take a look at the great financial crisis back here. Here is your good old downtrend on the monthly prior to the big painful watershed moment. We don't have the .com era here, maybe on the RUT. Do we have RUT? Yes, we do. So this had been in a grinding downtrend for a while. Of course, because of the concentration in tech, it was not going to be as bad here anyways, but just a persistent monthly downtrend, of course, is not fun to go from, 575 down to about 336. So, taking about a 30% haircut there, not really fond of that. So are we in a monthly downtrend? Is there a risk of a monthly downtrend? The answer is no. November's bar looks very, very strong as of right now. Let's take this back over to the IWM, and we will jump on into the weekly chart here. As of right now, a little indecisive doji. It's a little wicky on the upside, and we hardly closed right at the top end of this move from back here. So not the strongest display of strength, but like the other indices, we do have a gap fill reversal. There's nothing overly bearish here, I would say, until we get underneath, or if the market were to get underneath that 227 mark that we were just describing. This pullback here would still, sort of keep me on board for a small caps rally in the upward direction. As long as we're holding over that 227 on the weekly, even the monthly, I think the structure persists as being bullish. I would really change my tone if the market found a lower high underneath that, starting to think about a larger trend reversal on these timeframes. Just not seeing it as of right now. It's bulls on parade. Let's take this down to a daily time frame chart, see what's going on with the measured move, expected move, I should say, for the week here. The daily chart is not as clean as the others, and the reason I say that is just because of the number of upper wicks that have formed up here. The market's very indecisive around these IWM small cap all-time highs. Regardless, here is the expected move for the week. If contained by the upper bound, we have 247.80, implying a higher high, new all-time high. And if we're contained by the lower bound, the number is, let me squint real hard at the screen there, 235.90, give or take, 235.90 it looks like. If we're contained by that, that's clearly an opportunity for a huge daily higher low over key structure as well. Remember that this consolidation really set the tone for this breakdown. This is all thin structure in this zone right here. So if we could stay over that, then I think we're good to go. Notice the update of the daily higher low line in the sand. There it is. This gap has been closed, of course, but I'm still using those levels as some thresholds. Let's auto zoom that back to something a bit more comfortable to look at. So if we're underneath this, which is basically the gap fill reversal at 239.30, what would that imply? Well, you have a very short-term double top in play. You're under the neckline, and as described, you would need to hold this level here. Below that, I really think the market has a clean rotation from point A that we've just labeled to point B down here at 230.25 because, as mentioned, this, of course, is simply thin structure. What goes straight down goes straight up, can probably come straight back down with no gravity switch on. Let's drop this over to the hourly time frame chart so you can see that. Here is your straight down. Here is your straight up. Remember, we had talked about this textbook, absolutely textbook, inverted head and shoulders, thin structure retracement, beautiful, absolutely beautiful out of smalls. So generally speaking, on the daily chart, if we're over this 236, no issues. If we're underneath, then yeah, I think that we come down here and there's the opportunity for a lower high, maybe a stronger weekly consolidation builds out at that point. But as of right now, that's like a big stretch of the imagination. Yeah, we have a very timid market here out of small caps near these highs, but we haven't really seen stronger selling persist. To me, it would just be that we don't have confident longs, right? You can see that the market tries to rally and then longs just like fizzle out, right, and do nothing. But this isn't necessarily stronger selling. You see the same thing here on the Friday session, right? You get a strong move to the upside out of the gates, then you just sort of see it fade off into the afternoon. So not that we have stronger sellers, it's just a lack of buyers at this moment, and a lack of buyers can cause downside in the market, but I just wouldn't be prepared for like a huge trend reversal when all of the evidence we've seen so far really supports the continuation of these markets in the upward direction after either consolidation or some sort of higher low pullback, right? Obviously, Brigade bullets to blue sky territories take care of themselves. We talked about how this maybe sets up a short-term double top. Here is your top one, top two, if you will. Under the neckline, that level is 239.30, targets 236, as mentioned, a lower high here. It's a little bit more dangerous thinking about that cleaner rotation down into 230.25 as we have described. So all set here on small caps. Let's quickly take a look at the Russell internals, and we'll speed through the remainder of the supporting evidence as we are I'd prefer to go out and enjoy the day. It's not technically 6:45 over here. It's actually right around lunchtime, and I want to go back outside. I want to go grab another coffee. I want to go explore all of the little alleyways that Barcelona has to offer. The Sagrada Familia was absolutely stunning. I was able to check that out, go up to the towers, and we'll talk more about it when we get into the live streams. But the Russell internals, what do we see? Generally flatter on the Friday session, flatter towards the zero line here, and a little bit flatter on the cumulative build before the end of day madness with the closure of markets earlier in the week as well. Pretty flat here, not really seeing substantial volume inflows. Monday's session, you had some substantial movement here to the upside, but nothing that really sustained that, right? You know that we faded that into the afternoon, then sort of got this weak consolidation, very tepid market into the remainder of the week. So I think internals support that. But again, the main point here is to just continue calling out. We might not have strong buyers, but we also don't have stronger sellers. It doesn't seem to me that there's, a huge recipe for a, 50% correction in smalls based on what we're seeing here. Let's jump on over to, do we have the Russell in here? We don't. All right, let's try RTY, and we'll get the Z contract. There we go. We'll update the market profile here. What do we see? Generally speaking, I think it's just exactly what we talked about on the NASDAQ that's already in force. Notice that you have overhead supply trapped from that Monday session, which was, the strongest of the sessions we've seen. Tuesday is trapped, Wednesday is trapped, Thursday can't make much progress, Friday can't make much progress. All of these sessions are underneath the value area low from Monday. So I think it's a classic situation where you just have trapped overhead supply, which is, allowing basically anybody who wants to get out for break even, they're selling this pop, right? They're selling this pop here, just saying like, okay, I don't want to be long here at the all-time high, basically. Let me see if I can get a better position. Let's close out for now. So not stronger selling, just seems like, lack of new money buyers. I think we've been very clear about that analysis so far. Let's jump on over to the sectors and see what's going on from this perspective. We, of course, let's jump on let's talk about the performance first. So the weekly performance, we see the TLT leading the pack, not technically a sector, but up 1.92%, which, of course, is one of the reasons that the market rallied so firmly, at least in the S&P 500, back up to new all-time highs, is that rates absolutely collapsed into the end of last week. We'll talk more about the TNX in just a moment. Healthcare then leads up 1.8%, followed by real estate communications. At the bottom end of the barrel, it's energy, semiconductors, and the tech sector. So a little bit of a risk-off looking rotation with the underperformance from the technology side of the market, but is that a shock with the QQQ underperforming? Answer should probably be not really. Let's take a look at the structural chart. So the TLT, again, breaking out over this 93. In hindsight, it's just like, wow, I wish I sold way more puts or even just got long calls, TLT, instead of just, selling a small batch down here on the strike at least. So anyways, trade's working out, no complaints, just wish it was sized differently or there's different sort of approach. Anyways, as long as we're over 93, there's clearly an opportunity for bonds to continue to catch a bid. And if that's the case, rates should continue to come in a little bit, which aligns with a bullish environment for the IWM small caps. And generally, that'll act as a bullish tailwind for the S&P 500. So no threats here out of the TLT. If you look at the XLV, you can clearly see, straight back in the upward direction, retracing all of the RFK breakdown basically. But now is the big test. This week is all about 148. If you find a lower high here, danger, Red Ranger. I don't think we're out of the woods. You set up a huge weekly possible head and shoulders. I'm not saying we're there yet, but it's a possibility. If you poke through it with consolidation here, save the day, and I would continue to look bullish for the S&P. Remember, that's the third heaviest weight sector, right? Actually, I think someone corrected me in the comments the other day. I think the XLY has overtaken the XLV in terms of market cap. So I'll possibly have to look that up and double check. But anyways, they're up there. They're battling for 3 and 4. Real estate, no new swing high, so not overly concerned here. But if it does make a new swing high, great. That's technically bullish for markets. And think about the cyclical component of real estate, especially if we start looking at building permits, although new builds are not technically up. There's the turnover of housing units basically is bullish for the cyclical side. So real estate being higher, obviously on lower rates, makes a lot of sense here. Communications, new all-time high, nothing bearish to say about that as long as we're over 97.65. Consumer staples, strong move in the upward direction. Remember, this is D for defensive, but it's very lightweight sector, so we don't want leading the show. It's not pushing into new all-time highs. Generally, just bullish still for the broad market. Utilities are making new highs here and consolidating towards the top end of the range, so not really the best look as the market's trying to do so as well. This seems to me like a little bit of a weaker push in the upward direction. We'll see this on the SMH and XLK in particular in a moment. If this holds over 81.90, it's technically going to be bullish for the S&P, but in terms of risk on, risk off posture, not really a warm and fuzzy feeling inside. Here's the XLY consumer discretionary breaking new all-time highs. Again, nothing bearish to say about this. If we zoom in on the most recent price action, the unfilled gap is bullish, just indicating that sellers could not do their job and take out the thin structure after multiple attempts, right? On Tuesday, you get a move underneath Monday's low. On Wednesday, you get a move underneath Tuesday's low. Sellers could not make it happen. The gap remains unclosed. And of course, we closed at the top end of the weekly range, so bullish here. Let's take a look at financials, continuing to be bullish as well, breaking out to new all-time highs from this really compressed range. This is the second heaviest weight sector by market cap. That absolutely is fuel in the upward direction for the S&P. So as we look at something like the XLF supporting the move higher to new all-time highs in the S&P 500, not really the end of the world there. Let's move along to the XLI industrials, poking to new highs into the end of the week, looking for follow through to the upside. Any consolidation high or low over 141.60 is bullish for the market. Materials, really lightweight sector, just kind of like the recapture of 93.60 is constructive in the upward direction, but until it makes a new pivot high, probably over this to make it to the all-time highs, lackluster. It's the lightest weight sector in the market. Energy is lightweight as well. Big move to the downside here earlier on in the week, but to me, it's just a huge retest of this daily Brigade bolt. If you're over 94.25, really not much of a concern. If you do poke underneath, probably looking at 92 here, which is the top of this gap from in the past. Generally speaking, this is kind of neutral for the market here. Bullish if this takes place. Remember, this also speaks to global demand. And then, of course, anything down here starts to be not so great, but it's such a lightweight sector. I wouldn't say it has enough. It doesn't have the capacity to really crash, so to speak, for the use of an extreme term. The S&P 500 semiconductors not out of the woods. I was waiting to get to this point. Generally speaking, this strikes me as still being an opportunity for a lower high, bearish inverted hammer on the Friday session to follow up the bullish hammer off the 200 SMA on Wednesday. That closure is going to throw me off. So as long as we're underneath 245, I mean, this has to be, you could call it an H pattern, you could call it a bear flag, whatever you want to call this thing, you can call it, but it's got to be bearish, right? You could even go out on a limb and say, like, you have a double top here, you have a huge neckline, underneath 237 gets bearish. You could call this the Man Ray pattern, right? Let me just draw this in properly. Yeah, look at this thing. Boom, there it is, right? You could call it a Man Ray, whatever you want to call this, you can absolutely call it. But underneath 237, I think we can all agree that it gets pretty dangerous back down towards this area around 221. Why is this such a cause for concern? Because the semiconductor sector, it's not really sector, industry, you could say, of the technology sector, is a huge component, huge heavyweight component, obviously, with NVIDIA's weighting in the S&P 500. Now it's the top dog. It's got to move in tandem with the S&P. Otherwise, I think you're relying way too heavily on something like the financial sector, which, don't get me wrong, it's the second heaviest weighted sector, but it's not nearly as heavyweight as the XLK, right? XLK is like over 30% of the S&P 500, a whole third just going to technology. So semiconductors are important to play catch up here. Ideally, you get consolidation over 245 if you want the market to continue in the upward direction, and it's continuously being supported by these other risk-on sectors, discretionary, financials. I would even go so far as to say communications here as well. So watching the SMH very closely this upcoming week, 245 and 237. Do we persist in here? If so, that's technically bearish consolidation under overhead supply. If we get above, good first steps to the upside. If we get below, buckle up. I don't think it's going to be easy per se into the end of year on the S&P 500, or at least it'll be just more lackluster. You'll get stagnation there in the S&P 500. It doesn't have to crash, but you're probably not seeing sustained, bullish, big bullish breakouts to the upside, right? XLK, the technology sector, looks a little bit better than the SMH, noting that we do have the attempt at a higher low over the 50 SMA, not quite an equal low down here, and we did close back over this little top of the 4-day balance from in the past. So a good first step, but ideally, this gets consolidation here and goes on to print new all-time highs as the S&P is printing new all-time highs. So 234 and 238 are top watches out of the XLK. I'd say anything that's underneath this gap here at 228 really starts to become more of the danger for downward pressure. Let's check in on the sector performance in terms of ratios. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. This still strikes me as neutral. This strikes me as being bullish. This strikes me as being bullish. This is neutral. So in the top 4 quadrants, we of course have 2 out of 4 checking the bullish boxes and neutral on the rest. So I'd really call that, let's say, 3.5. Tick to the risk on side. This, of course, leans more risk on here as well. This is not risk off, still underneath a 50 SMA, which is sloping lower. This is a little bit more neutral. It's starting to become a little bit more concerning. We saw that on the structural chart as well, anyways, out of utilities. But generally speaking, the snapshot of the market here is not that we have a bearish risk off rotation where, oh my goodness, the market should be crashing and going to zero. As of right now, it looks like, yeah, the steam is slowing down here near the highs, but it's really just due to what we see out of the XLK and the technology component in the market. If we look at some specialized ratios, we can sort of see this reinforced, right? So this is 1 to 3 year treasuries versus the XLK, and you can see it's trying to tick higher here, but generally speaking, lower high is in place. It's more so a range compression. Whether or not this breaks to the upside or downside, we are yet to see. If it's the upside, risk on. If it's the downside, a little bit more reserved in the approach. If we're looking at the XLY, screaming risk on relative to the XLP, so it's discretionary versus staples. This is utilities versus the technology sector. It's still sort of struggling down here. This actually does strike me as sort of a failure. At this point, we needed to see a higher low over the 50 SMA. Into the end of last week, we certainly broke down a little bit more aggressively into what I would start considering even just an equal low. So not really thrilled about this chart. That one definitely leans risk off. This is a little bit more neutral. This is risk on. And lastly, we have semiconductors versus the healthcare sector. Again, pulling back a little bit more aggressively than I would have liked. So it's not that it's full-blown risk off. These are clearly not in big downtrends yet. Not in a downtrend here, not in a downtrend here. Pulling back, neutralizing. but it's just not as bullish as it could have been, right? That's sort of been the take here through today's episode, which is that, yeah, we want to continue to trade in the upward direction, but maybe have some reservations here near the all-time highs. That's sort of what I'm seeing from the analysis. Let's take a look at the dollar, which continues to scream in the upward direction. Look at that move here. So pulling back, but I think this is nothing more than a huge retest opportunity. Let's go to a weekly chart here. Look at this long persistent range. If this holds up over 105.65, I think it easily catches itself for a higher low and continues in the upward direction. If it comes back into range and consolidates, then great. I think that would technically be bullish for equities down below. Remember that for every 1% that this moves up here, the earnings expectation of the S&P 500 should technically move by inverse about 0.5%, right? So generally speaking, as this comes in, it should support higher equities. If it supports and rallies, it should support lower equities, right? A stronger dollar there weighs on the market. If we take a look at gold, expressed as a currency here as well, starting to put in a possible lower high underneath this previous breakout point. And honestly, this is obvious with the contract roll, it's a little skewed, but you can see underneath this 2690, if you just set this lower high and this persists as a lower high underneath the breakout point on the relative ratio, this is gold versus the S&P 500, I still don't think that we necessarily have a flight to safety happening here in the gold contract. Recall that I had expressed some concern if we got up here. It doesn't look likely now that you have this sort of trend reversal, right? From here to here, you set a lower low. From here to here, it's possible, we don't know yet, but it's possible that this persists as a lower high. We will know that when and if we make an equal low or another lower low, and from there, the trend will have confirmed a move in the downward direction, a reversal, basically. So with gold not signaling flight to safety, I just generally speaking don't think that the market's in a precarious position to say like, oh my goodness, we should sell everything, get the heck out of Dodge, and prepare for a big Armageddon move. Look at rates coming into the downside, of course, as well. So sort of in tandem with that dollar moving lower, this is supportive of higher valuations in equities finally. There's this huge disjoint that we'd been talking about for what felt like months and months and months on end. It was really only like a month and a half. But all through November, basically, we were like, wow, rates really remaining elevated, yet the market's continuing to rally in the upward direction, even in the face of Jerome Powell. Like, he cut rates down here and boom, rates rallied like a madman. So this big disjoint is starting to unwind a little bit. It's starting to get a little bit more attractive and supportive of the rally that we've seen in equities down below. So watching for sustained price activity underneath 4.3 basically on the 10-year yield. If we take a look at the inverted ZT for the Fed tracker tool, basically we can expect that the odds should have increased for a rate cut here in the month of December, but actually I think the odds went the other way. So more so stabilizing would be a bullish indication for the Fed tracker tool. Let's get on over there now, actually, take a look. Yeah, I mean, I guess they're still expressing themselves around 60-40, 65-40, 35, happening here. So 66% odds of a 25 basis point cut on the table for December. I'm going to continue to keep tabs on that. I think after the PCE, I would have expected, honestly, the odds to shift even more back into a balance around, 60-40, 65-35 the other way, expecting more of a pause over here. Because if you take a look at how PCE, and I'm sort of, admittedly here, I was not trading on Wednesday. That's when I was flying over, landed in Barcelona, and then that day opened. But if you look at PCE, in hindsight here, sort of analyzing what happened, I mean, the market, it should not have liked that 0.3. 0.3 is the hottest read. If I just look at some of these prints over here, it's the hottest read since March. Thank you to Kathy Jones. And I mean, it's not the direction that the market wants to see inflation moving. So I'm surprised that we're still seeing such strong odds of a 25 basis point rate cut in December. And even if you scroll down here a little bit, you can see that we're starting to flatten out above the Fed's 2% target. So of course, core is in orange, non-core PCE is in blue. I mean, we've sort of bottomed out right around 2% and now we're starting to uptick. Remember, core PCE is the Fed's favorite measure of inflation, which is finding a bit of a footing here at, like, what would you say? Maybe something like, let's zoom in on that, see if we can get a closer detail. So 2.5, right? 2.5 appears to be the current floor for the core PCE read. So generally speaking, a little bit perplexed that the market took that number in stride on Wednesday. I mean, it did come in at the expectations. It did not miss expectations. People were expecting the 0.3 and we got the 0.3. It's just not, to me, it's not enough progress towards the Fed's target of 2% inflation. So anyways, what do I know? The market's going to do what the market's going to do, and that's why we rely on the technicals with the understanding of the fundamental background. If we dive into the PCE report itself, I think what's probably most compelling is just the argument that we know goods deflation has been here for a while, and that's helping the case for inflation coming down. And we also know that obviously services is the sticky side of inflation, and that remains hot here at a 0.4 on the month over month. Can't really sustain that on an annualized basis. But if you move down to where is it? We want housing and utilities. That's the driver of the services side of things. And the argument from Jerome Powell is that services side, specifically housing and insurance, is a lagging metric, right? Because those things only renew once a year. New leases, new term premiums, right, for your house, healthcare, whatever it may be. So those insurance reads are going to read hot for a bit, and we're not really worried about them. Like, they will come back down into line eventually, is basically what he said. It's transitory. We all know what happened when he used the term transitory last, but that could be the explanation as to why markets did not care so much about the hot print on Wednesday. We'll see how this upcoming week's labor report really impacts the market, because that is what we have to look forward to next. So while we're on the topic of reports coming out in the morning, I just want to sort of say, I don't know how good the Wi-Fi will be for potentially live streaming a broadcast on Monday. We'll try it out and see what happens here up from the remote penthouse, but no promises. We'll try to make something happen. But if you're not following us over on X, we've really been putting some effort into posting a lot of updated analysis over on X, updating charts after the close of every day. So if you want updates for what's in play the following day, look at the X feed. And that's something that I can do. I mean, the market closes here at like 10 p.m. Local time. So after, in the afternoon, after dinner or something like that, I'd love to just check on some charts and, sit at a cafe and blast out a bunch of tweets. So I love doing that. And you should check that out if you have not already. Anyways, this upcoming week, manufacturing and services PMIs will come out. Obviously, manufacturing ahead of services. You have Monday and Wednesday respectively. Ignore these times. Of course, this is my local time now. So this would be 9:45. This would be 10 o'clock, right? And this is after the close there. This is going to be, what is this? This is the 10 o'clock time frame. JOLTS openings, 10 o'clock Eastern time. JOLTS job reports come out. Then you have ADP on that is going to be 8:15 Eastern time, right? Is going to be your ADP JOLTS, ADP non-farm services PMI at the 10 o'clock time frame. Powell looks like he's speaking at, don't ask me what time that is, sometime in the afternoon, maybe midday. And then we have on Thursday, unemployment claims, most importantly on Friday. I'll be back in the U.S. For Thursday and Friday, likely. But Friday, December 6th, we will have the full Monty labor report, and that's where we're going to find out, I think, one of the things to be mindful of here. Let me just actually go on over to our profile, and if I take a look at this, let's jump over here. This chart is continuing claims in orange versus initial jobless claims in blue. You'll notice that we have continuing claims on the rise, meaning that people are not finding new work, but people are not getting laid off as aggressively. So you're going to enter this precarious position where I think companies are tightening up the belt a little bit, not laying people off, but not so much, I should say, onboarding people, which could imply that your number is weak here on Friday, right? The NFP could be pretty weak here, expecting 202. Remember last time we got 12 and it was just like a jaw-dropping moment, like, okay, is there something broken with the data? So I don't know that we should be expecting 202,000 after what we just saw here on the spread between continuing and initial jobless claims. Anyways, that's your fundamental take for the week. Here is the earnings calendar. I would say that CRM Salesforce is going to be interesting. Marvel on the heels of the semiconductor space, of course. And then as we move into the end, SentinelOne from a cybersecurity perspective, perhaps worth watching there. What else is worth a watch? Lululemon. Everybody loves Lulu there. You've got, what else? That's it. Maybe DocuSign breaking out of a multi-week, is it year? Maybe month. Multi-month base as well, down towards its lows. This, along with Zoom from last week, really have some pretty impressive looking charts. So that's going to do it on the fundamental front now. Let's jump back on over to some of the risk appetite charts. We'll keep the show on the road. TLT ratio to the S&P is putting in a little bit of a bottom here. Again, I would not call this a flight to safety yet, but if it does outperform and start trending aggressively higher, that would be something worth watching for. As we did back here, if we were to take out this prior high, we would have been concerned because of the trend reversal. I'll do the same thing with this level in here. Don't worry so much about the precise number or dot, but on a ratio chart, whatever your current ratio is reading, if you take out this previous high, that's where I would say, okay, a little bit more of a flight to safety is possibly unfolding here. And bonds do look attractive, right? Obviously the valuation on them was very, very low headed into this cutting cycle. So With that, what else is going on here? We have ourselves these ratios, bonds relative to themselves, rolling over with the big drawdown on the Friday session, specifically in rates. And that makes sense, right? So all set here. This is sort of signaling that the market's maybe not as concerned about inflation, which to me still seems odd. But we know it's not goods. It's mainly housing services. So all set on that front. We talked about that fundamental explanation already. Credit spreads are rolling over to the downside here and here, so volatility should not really be seeing a substantial uptick. All set on that front. If we take a look at the high yield junk by itself, it was making a new high here into the end of the week, which to me supports the idea that the bulls remain in control. Yes, technically it's divergent from here to like here if you were to draw these lines, obviously. However, in the very short term, I do like the fact that this is continuing to push in the upward direction, supporting more of the bull case. If we look at Bitcoin, the risk appetite remains elevated. You'll just notice like bullish consolidation up here. If we take this down to a daily, mind you, the Saylor shift ratio will not work on the daily. This was built for the weekly chart. But if we go to the daily really quickly, and you look at this pullback, just a beautiful, look at the higher low over the previous rejection highs, right? Just a beautiful, beautiful structural pullback here on the Bitcoin daily chart. To me, it's just sort of like a matter of time before 100K is ultimately hit, and we'll go from there. Let's take a look at total breadth and see what's going on with the breadth of the market as this push has happened. So improvements out of the 50 SMA and 200 SMA there in green. New highs versus lows remains positive, which of course is bullish as well. The RSP was a huge giveaway as soon as this breakout was taking place there on the Monday gap up, gapping up and over this previous high. I know we didn't do a midweek update video. We were obviously 30,000 feet high in the sky. But generally speaking, this consolidation above the top end of this range, it's got to be about as bullish as it gets, right? So sustaining this price action up here in the RSP looks good, and once again, breadth is confirming the broadening out of the scope of this rally ultimately. If you look at the QQQE, it's the same exact thing. Notice the equal weight NASDAQ made a new high here versus the weighted did not. And of course, the main culprit has to be NVIDIA. NVIDIA is the magic offender, basically, at this point. That's probably not the best way to frame it, but you get the idea. Industrials versus transports continue to look good here. Transports are playing along nicely and making new highs finally with industrials. Thought we'd bring that up. If we look at volatility based on credit spreads, not a shock to see this moving lower. Of course, that's the VIX by itself. If we look at the VVIX, volatility of volatility, again, not a shocker over here. And if we take a look, these might be expired. Let's see what we have. Yeah, these are expired here. So we want now, what is the updated? Let's go over to the VX. This is some live adjustments of the contract. So we want Z and what? Z and F. Z and F is what we want on the chart. So let's go F up front, and then we will go Z in the back. There we have it. And if we update that, oh, please load for me. Can we get a load? Oh, it's 25. That's why. That's why we're adjusting contracts that way. Can you imagine that? Obviously, in a very deep contango at this point. I was thinking to myself, oh man, am I going to embarrass myself on the show not getting this thing to load properly? It was the year. It was the year. Let's put a left extension on this bad boy as well, and you can see we're just in a deep contango. So are there any issues right now from a volatility perspective? No. There is less risk in the present day, making it easier for money managers to allocate capital than there is in some unknown future, so why wait for that? Allocate capital now, and the S&P agrees with that, obviously, by extending its rally in the upward direction. Same thing here out of the 30-day versus 9-day VIX and the 1-day VIX down here sitting on its comfort zone at 745. Let's take a quick tour through some of the core list of companies and see exactly what's going on, beginning with NVIDIA, the one stock to rule them all. And what do we see? So I think NVIDIA is precariously positioned here because this is sort of like a balance range. You had to look above and fail. And this starts to suggest look below and fail. I would say the next key steps out of NVIDIA have to be a sustained hold over 137.25. If you could hold over that and Brigade bolt over 141.15, I think you get the full rotation up towards 149.25, and that of course would be bullish for broad markets, pushing the S&P 500 likely to a new all-time high. If you're underneath this 137.25, it's a balance range breakdown, and just call it for what it is. It's a bear flag, right? And you can see this as clear as day on the hourly chart, where if this is going to build out as an inverted head and shoulders, hold that 137.25, Brigade bolt here, you have thin structure to retrace. This is just volatility from earnings, right? So that's your upside, downside. Once again, this starts to become a little bit more concerning, and under 132.25 opens the floodgates to the downside. Microsoft is kind of ugly on the daily chart. You guys know what we say here around the channel. We say don't exchange in the range, don't enter in the center, don't diddle in the middle. Right now, Microsoft is smack in the midpoint of its range. You could start to call for some sort of range compression compression here if you were to do this and maybe, I don't know, cherry pick a high from back here and do this. Range compression, sure. Generally speaking, in the short term, lows, higher lows, higher lows. If this can persist here after we've now made an equal high, which is why I'm leaning more so into the long side of things, if we could persist over 419.60, technically it's a flag in the midpoint, right, if you were to do this, and then over the top end should bring you into 440.65. So watching out for something like that into the near-term future here, but if it breaks down, I would really just be more so neutral in the grand scheme of things out of Microsoft than anything else. If you take a look at the hourly chart here, strong response on Friday, basically the shortened holiday session, off of this zone. This zone really acted as the top end of this balance range here. Took a little while to resolve, but for now it does seem as though the short-term bulls have control. Apple, daily time frame chart is a requirement here. This is a massive ascending triangle, wedge, whatever you want to call this thing. It's starting to break out of it, right? So as long as we're over 233 on Apple, I think new all-time highs are really the name of the game here. 237.50, it's technically 49, but over 237.50 unlocks those blue sky territories. I would start to have more concerns about Apple. I would give it some leeway underneath 233. I wouldn't be thrilled underneath 233, but if it supports the daily 50 SMA again, if it supports for a higher low over 229.50, let's zoom in on this a little bit. If we get a higher low here on the daily chart, then I would say it's still in play and still looking for that blue sky territory. If we fall and fade for a lower high inside of this range, off the table, more so neutral than anything else. Moving along to Amazon. Amazon looks really good here for a potential move to close the gap overhead. This is a trade that we've been waiting very patiently for over the last little bit, ever since this breakdown over here, really ever since this double bottom, right? We were saying we wanted consolidation for a gap close. Did the look below and fail, right? Look below and fail here. So now it's just next steps, very clear. If it can stay over 207.35, closes the gap to 10.85. If it consolidates here, still in play. Looking for this over time. Obviously this, just rock and roll the blue sky territories. I would be bearish if this happens here. Why? Because daily lower high threat. Daily lower high threat. That's 204.35. Moving along to GOOGL, what do we see out of Goog? I think the 169 level is just extremely heavy here. You have a massive inverted head and shoulders neckline. Big breakout on earnings, faded it once, moved back to the upside, faded it twice, could not get that third rotation for the round tripping, if you will, back up to 180.95. So if we currently stay underneath 169, I mean, just call it for what it is. Daily lower high underneath the breakout level, failed breakout, and of course, the floodgates open up underneath 162.75 for a flush through this thin structure here towards the left shoulder at 155.50. I'm not calling for Armageddon. I'm not saying it needs to go there over the span of like 2 trading sessions. Obviously, it can if it would like to. Look at the volatility here and here. But generally speaking, I'm just more bearish on Google under 169. If we're over it, I do think there's an opportunity for a Stevie Wonder squeeze, and that would just be like, if you could take out these highs, look left, the thin structure retraces, probably targeting the origin of that breakdown around 173.75. So 169, it's just your arbiter of price. We don't really have a clean resolution of this yet, so you're really going to have to watch early in the week. Do we rally away or do we fade away? It's one or the other here out of Google. 169 is the number to beat. Let's take a look at the metaverse and see what's going on with Zuckerberg's fantasy land. It's really not a great looking chart. Here's just like a consolidation range. It's starting to solidify a little bit more so the look below and fail, but I'm not sold on it yet, or I should say I'm not buying into the pattern just yet, literally and figuratively. The reason being is on the hourly chart, it's just so sloppy around this 561. That's the bottom end of the balance range. There was not much respect for it. Here on the initial gap up, second gap up, no luck. Here opened above, no luck. This undercut and then rallied. And I mean, technically this is now a higher low above. Really, really sloppy chart, as we can all see here and probably agree. So how do we trade this? If we can resolve 574 to the upside, maybe that's where it takes place. But if we're just chopping around through here, I really don't think the indication is clean. Generally speaking, you want to try to establish trades that exploit this type of range here. Risk interval in the lower box and reward interval in the upper box. Moving along to Tesla, not the one stock to rule them all, but Mr. Musk is back in business here. What do we see? A little bit of a move lower, but FSD, all of the people on X who had commented on our analysis post of this, kudos to you. Probably strong move there into the Friday session. So back inside of this balance, I'm a little bit more bought into the pattern when and if we can get back over 347. If we can, then great. What does it suggest? Just a massive ascending triangle over 350, 850, talking about 382. The range really opens up from back here because of the way that the breakdown was so aggressive, right? So over 347 is your key watch out of Tesla, looking for some upside. To the downside, if this is going to play as a double top, what do you need? You need to be under this at 312, and it's just clearly not in play as of right now. I would say the bears probably build back some of the edge if we're under 335, but with the close on Friday, I'm just not not sold into that idea either. I think that in here we're neutral. I think here we want to trade for longs, and I think down here, we're getting ready for shorts, but probably the most prominent one would have to be under 325 to trade into the neckline in the first place. So one step at a time here out of Tesla, but probably leans more so long than short, with the sort of look below and fail back to the top end of the range, looking for continued upside here. JP Morgan, like the XLF, just continuing to truck along in the upward direction. It still seems like we have timid buyers, not getting follow through in the upward direction, but is it bearish? No. We're still over the top end of the earnings range, which was set from back here. So another day in paradise just persists as long as we're consolidating above. Let's take a look at Netflix. This is a monster, absolute monster. So the pullback was very mild. We did start to establish a little bit stronger of a base here at 868. So we can use that to manage some risk. On the hourly chart, I think this is where the trade actually plays out from. Notice that this is a lower low double bottom, and you made it over the neckline here. So any higher lows over 882.50 should rotate into that all-time high, right? That's the measured move from the double bottom, roughly, and also just an hourly trend reversal. You had highs, lower highs, lows, lower lows. That's straight back in the upward direction. Lows, highs, higher highs, right? So as long as this holds, 882.50, looking good. 907.25 would be that target. If you want additional trade ideas, again, check us out over on X. The link is down below in the description, and you can follow us over there for more chart setups. Recently we've been talking about quantum computing in IONQ. We've talked about PLTR, of course, Palantir. We've talked a little bit about AMD. If you're missing AMD, you can find that on the Twitter feed. We've been following Bitcoin more closely over there, so go check that out. Some more trade ideas to follow over the span of this weekend. It's easier to not film a full video, but just, of course, send out some posts every now and then. Don't forget, I'm not sure if the TradeZella Black Friday deal is still in play by the time you guys see this video, but TradeZella is offering a Black Friday deal. You can try the coupon code Black Friday. So use the link down below in the description, right? So we have it's an affiliate link there, so full transparency. I'll get a little kickback on this, but if you are going to sign up for the service anyways, use the link in the description. Do not use the code TB10 and instead use the code Black Friday. If you use the link below and still use Black Friday, we'll get credit for it. Again, if you want to support the channel, that's one way to do it, but it's an awesome tool. Ever since they reached out and sort of sponsored the morning show and offered this affiliate sort of program, I've been using the platform. If you've been in the back end of the trading course, you, of course, can see the recaps there. It's a really awesome way to aggregate the data. It's something that will easily point out where you need to improve and what you're already doing well. So if that's something you're interested in, check it out. We don't really, we don't push very many things here, but it's a trading tool that is extremely useful in terms of being able to aggregate your data and not spend all the time building a custom Excel spreadsheet yourself. So with that said, we are going to wrap it up for today's episode of the Weekly Watch List. I'm going to go for a stroll and get a café con leche and possibly, explore the alleyways. So have yourself a green upcoming trading week, and as always, I will see you in the next one.